Hello and welcome to BST Live, the show for systematic and algorithmic traders. Thanks for joining us today, where we're going to be talking about how to avoid curve fitting using independent testing. We've got a very special guest here today. This is someone I've been wanting to get on the show for years, and today is finally the day. And so welcome, Jeff Swanson. Thanks for joining us today. We're missing the audio. Hang on a sec. Let me just try this. Hi, Jeff. Can you hear? Can we hear you?
I can hear you well. Can you hear me?
Excellent. Yes. So welcome to the show. As I was saying, it's I've been wanting to get you on the show for years, and now you're finally here. So I'm very excited. How are you?
I'm very excited as well. Thanks for having me. I really appreciate it.
Yeah. So we're going to be talking about how to avoid curve fitting today, using a technique you call independent testing. And so before we get to that, though, how about we look at a little bit of background on yourself, just so that we can get some context. I'm sure a lot of people know you from your website, and but how about some background on yourself? How did you get started in trading?
Well, I got started in trading actually back in high school. I took in a class in high school, if you can believe it, where they taught us about trading and what investing and what stocks were. And so I first bought my first stock right out of high school. And, this is kind of a funny one, Andrew, because I'm a child of the 80s. So if you can imagine a guy with long hair and a leather jacket, this is 1989. We had to pick up the phone to make orders, and I had to go find out what a broker was. And when I went through the yellow pages. People won't know what that is, but I had to go through the yellow pages, find a broker, and I saved up $1,000 from doing odd jobs. And when I walked into that brokerage house, they just stopped and stared at me. They were like, "This person's probably in the wrong spot." And I felt really stupid, and because I had no idea what I was doing. But they were very nice to me, and I remember opening up my first account in 1989, right out of high school, and I was debating between AT&T and Walmart. And that was my first experience, and I held those for a few years, and I just thought it was the most interesting thing. And then fast forward, then I played around in the dot-com era, lost a bunch of money there in the dot-com boom. That's where I started day trading a little bit, and Mother Market gave me the punch in the face, so to speak. Lost a bunch of money. And then a few years later, I discovered futures. And like most people, this is right around the financial crisis, 2008, 2009. I started day trading with futures. I started reading about it more, and went through hell with that. That was a very difficult time. And really things started changing after that, shortly after that, around 2009, 2010, when I discovered that, hey, you could take a computer and have it trade your patterns and your methods. And once I discovered that and saw that I was the shortest or the weakest link in the chain, so to speak, that's when things really changed. And I really loved the merger of computer technology and trading, and that was my that's my story. And it's probably a very similar story where I couldn't trade as a discretionary trader, but in system trading I can do okay.
Yeah. Okay, so you mentioned that futures and systematic trading, but do you focus on any particular styles like breakouts or mean reversion? Like, can you tell us a bit more about the style of your trading?
Yeah. It's a combination of mean reversion and breakouts. I do have a lot of breakouts. I have mean reversion and short-term trend following. So everything I trade is futures, and everything is held either for a few hours, one day, or maybe several days. There's nothing I really, I don't have a system right now where I'm holding for more than a week, let's say. That would probably be the longest time frame.
Yeah. Okay. Well, today you're going to be talking to us about how to avoid curve fitting, and we've had a good comment in the chat. Actually, I want to share this early. I don't usually share comments so early, but I think it's very appropriate. This one's from Eli. Curve fitting is the kryptonite to all systematic traders, which is a which is a good comment. So we're going to be talking about independent testing. But first of all, I know you do a lot of work with traders and coaching, and you've got courses and stuff. Before we get into the independent testing part, can you talk a little bit more about the things that you see traders do, which has an impact on curve fitting and overall the quality of the trading strategies that come out of that process?
Yeah, in general, people see when building systems, when they look at the back test and they're building their trading systems, they get too hung up on making it look perfect. That's what it comes down to, is they want to remove every little squiggle, every little downturn. And I think Kevin Davies said something about torturing your data. I believe that was a quote, something he said. And that's what happens. People just get hung up on making the perfect looking back test. And the reality is, once you start understanding how a trading platform works, the back test is nothing more than really a rough estimate. It's not reality. And you're never going to build the perfect system. And what people end up doing is actually building pretty looking back tests. That's what they learn to do. And so there's, I think that's a real important one. Just overfitting is they just continually hammer away at it, adding filter upon filter, keep on working on it for weeks and weeks, and they just torture the data.
Yeah. And so what is the result of that? What kind of strategies come out of that process by torturing the
generally
data?
What happens is you get a system it's way overfit. It's not likely to work going forward on the live market. And that's the bane of system trading, or probably, any type of systematic trading, even fully automated like what we do. And that's what people experience. And I think a lot of people can experience. I know I can experience that too. I used to build pretty looking equity curves as well. And sure enough, they just wouldn't hold up going forward.
Yeah. Okay, so now this independent testing technique, I'm really interested to dive in deeper into that. So how about, can we start by explaining a little bit about what is it at a high level, and then, we'll get into more of the details a bit later. So what's independent testing? Yeah,
well, first of all, I want to point out that in my head, curve fitting isn't bad. We're in the business of curve fitting. Okay, so what we're doing is building algorithms that look for reoccurring patterns in the price, right, that extend over many years. And so we want our systems to be curve fit to those patterns. That's what we're doing. So in mathematics, there's something called curve fitting, where you build a formula, an equation that best represents the historic data. That's what we're doing. That's what we want to do. Our problem comes in when we overfit. And that means we're going to start keying off of noise in the data, and we're not actually keying in on that actual pattern. We're keying on noise and randomness and an illusion, where that's what we end up doing. So when we go forward, it crashes. So I'll use the term curve fitting, I'll use the term overfitting, but really what we're talking about is overfitting. So what am I talking about with independent testing? Well, first of all, I don't think this is something that I came up with. I'm sure there's people out there that have written about this and have discovered this. I'm not that smart. I just kind of observe what I think works, and then I test it and see if it works or not. And so years ago, I came up with the idea of independent testing, and it seemed to work pretty well for me. And what it basically is opposite of the way most people build a system. When they build a system, they'll apply a filter to it. And then what they'll do is, oh, that worked pretty well. Then they're going to add another filter. And they're like, ooh, yeah, that looks pretty good, but there's a drawdown there. Let me add this filter. And so what they're doing is stacking filters, linking them together one after another. And what I do is completely different. I break those apart, and I only test one filter at a time, independently of any other filter. So in short, that's what that is.
Right. Okay. So I guess that's the name, independent testing, right? It's quite
right. That's kind of the name. I know it's a real sexy name. I'm terrible at coming up with names for things.
Okay. So then I guess the benefit to that, as you mentioned, is you can avoid curve fitting because you're not doing the stacking of the filters, which can get people into trouble. What other kinds of benefits can you get by doing this independent testing?
Sure. Yeah, I believe it avoids curve fitting because when you start stacking each filter on, every time you add a filter, you reduce your sample size. And so you're really then working with a smaller subset, and that subset is, tailored to the previous filter. And when you do that, not only do you can introduce curve fitting, but you don't really understand the impact of each filter. Maybe you have 3 filters, an RSI, maybe a filter against VIX, and then another price action filter. If you test them independently, you can actually measure and see the impact each filter has on your trading idea. And so that gives you a real good feel for, hey, this is really valuable, or this isn't so valuable. And I think that's really important.
Yeah, okay. So can you give us a little bit more of an example of the type of filters that you like to test? Like, for example, you just mentioned RSI and a couple others there, but out of this process, you must have found some ones that work better than others, or you have your favorites. Can you give us a couple of examples of
Sure. I don't know if I necessarily have any favorites. I know, if you corner me, I really like the simple bull-bear regime filter. I talk about that all the time.
Yeah.
And I think those are one things I test all the time on every trading system. And that is dividing the market into major regimes. And usually that's bull or bear. And often it's just a simple 200-day or 150-day moving average does well with that. So that's one I like a lot. I also like price action filters. What was yesterday's price action doing? What is price relative to a moving average as well? So, there's nothing really fancy about any of these, and it's really just how they were tested. So when you ask for a favorite, I actually have a library of filters that I have, and I've created easy language functions. And so when I'm testing, I call these functions, and it just rips through dozens and dozens, and perhaps even up to 100 different ones when I'm testing. And different markets have different favorites or ones that tend to pop up. Also, it depends on what type of market it is. So I prefer to just let the system tell me what's coming out, which one's the more favorable.
Yeah, sure. Okay, so can you explain a little bit more about the process you use to do this independent testing, perhaps an example or something like that, so that we can really solidify in our minds exactly what you're talking about here?
Sure. So what I first do is I start out with what I call a key idea. All my trading systems start out as a key idea. What is a key idea? It's nothing more than a simple observation. And that observation could be simple as, hey, if Monday's a down day, Tuesday, this is for the S&P, Tuesday is likely to be an up day. And so that's your key idea. And it's just that simple. And so you have your key idea. I'm going to call that my baseline now, okay? And we're going to compare everything going forward to our baseline. So next what I'll do is I'll take a filter. Maybe it's a simple moving average. I want to know, does this behave differently above the 200-day moving average or below the 200-day moving average? So I'll test that. And after I test it, I'll say, that looks pretty good. All right, so what I'll do is I'll set that aside, make a note, and then remove that code from my baseline. And so now we're back to the baseline system, and then I'll test another filter. Maybe I'll test the put-call ratio. See how that looks. Doesn't look so good. Remove it. Test maybe a price action filter. That looks really good. So then I'll make a note, that looks good, and remove it. And so I keep doing this again and again. And so maybe after I've tested 20 different ideas, maybe 3 of them look good. And so then at the very end, what I do is plug these in all together at once. And so these different filters have been tested independently, and then I combine them and see what it looks like. This is all working on the in sample and seeing what it looks like from there. And if it looks good, then we can move forward to doing the validation on the out of sample. So in gist, that's what it looks like. And that's it kind of in a nutshell. There's a couple other, do you have any questions on that? Or?
Well, yeah, I was just going to say, at the end there you said when it looks good, then you take it to the next step. How do you define when it looks good? What kind of things are you looking for at that level of testing?
Sure. When I'm testing things, I keep it pretty simple. Basically, what I want to see is either more profit or less drawdown. Okay, those are the biggies. And how can that be summed up? Well, net profit divided by drawdown. So I look at that figure quite a bit. The other thing I want to look at on intraday systems is what is it generating per trade. And I want to see with slippage and commissions, I really want to see it around 100 or more, okay? And those are the major things. Now, also what I'll look at is the equity curve. I think, like you, Andrew, you've probably seen, I don't know how many equity curves. I feel really comfortable looking at an equity curve and knowing, yeah, that's tradable, or no, that's not tradable. I could see the jagged lines. I could see the time between new equity highs, and I think I have a good feel for that. So I know that sounds really, that's really objective, but when it comes down to it, you want to have more profit and less drawdown. So I think that's a key metric there. So net profit versus drawdown is a great one to look at, and also general feel for the equity curve. So that's what I'm looking at when I mean looks good.
Yeah. Right. When you were just talking about, excuse me, sorry about that. When you're just talking about the filters then, do you have like a particular order that you test them in? Because I imagine some filters are more restrictive than others, so they could theoretically have a bigger impact, or they could filter out too many trades. Do you find that there's an order that you do that testing in?
Generally, what I'll do is when I divide the market up, that's the first thing I do. If I'm going to divide the market up in a bull-bear regime or high-low volatility, that's usually as far as I go with dividing up. That's the first thing that I'll do, is do that. That will always be the first thing that I test. And then finally, the last thing that I do is stop losses, my hard stop loss. So I generally like to test all my filters without a stop loss. I really want to see what is the filter doing by itself without something else interfering with it. So I want to remove as many extraneous variables from that and just see that. So those are my general rules of what gets in what order. So it's other than that, that's it, just those two.
Yeah, okay. So before we move on to the next step in the process after that, we've got a couple of questions about filters, so it might be good to raise them now. So here's one from Good Old Boy. G'day, Good Old Boy. Thanks for the question. Jeff, where do you get trading ideas to test?
Okay. Now, trading ideas to test, they are everywhere. So I find them on blogs. I find them on Stocks and Commodities magazine. Ideas from, even your podcast, definitely. To me, they're in books, they're in magazines, they're in blogs, you get everywhere. And I'm real aware of when I'm reading material or I hear an idea, I'm watching a TED Talk. What I have also is I use Evernote really heavily. So I have Evernote really on my phone, on my laptop, my iPad. And when I hear an idea, when I see something, I immediately write it down in Evernote. And I teach everyone, too, to do something very similar, just to always capture information as soon as you see it, because I'll forget it. I'll definitely forget it by the end of the day. And so if we go into my Evernote right now and take a look at the ideas that I have to test, I'm not going to live long enough. I have hundreds of ideas to test. So I think start looking for them out there and be aware of it, and make in a notebook somewhere, start writing these ideas down because they're everywhere.
Yeah. Okay, thank you for that one. Here's a question from Jeff J. G'day, Jeff J. Are there any leading filters that you use, such as Delta Advanced Decline?
I've tested a few of those, and I can't say a lot of those really pop up. They just don't come up for me. Now, I don't know, maybe I'm not using them right or whatnot, but in my case, I can't say that I depend on those very much.
Okay.
One that does, I should say, has come up in the past. I'm not using a system right now that's based upon it, but I have in the past. It has been the put-call ratio when trading the stock indexes. I used to use that years ago, and that produced that I was building systems from that was producing solid results. And I think what happened was TradeStation at one point got rid of the put-call, and I was trying to import it, and it was just causing more headaches. It's probably something I should revisit.
Yep. I just want to ask you a comment you made very early on was one of the issues with filters is that people like to add filter on top of filter on top of filter, and that can lead to issues. When you're doing this independent testing and you're adding filters, do you have a maximum you'll only add 3 filters or 2, or how do you manage that so that you know you're not actually adding too many?
You know, that's a real good question, and I certainly don't have any evidence for that. You know, 3 is the magic number or 5 is the magic number. Generally speaking, you know, as you add more filters, you're going to restrict the number of trades, so you'll have a smaller number of trades. And I start to get uncomfortable after you start narrowing 500 trades from your baseline to 50, right? That just doesn't seem right. You want to have over 100. Generally speaking, I don't look at that. How many filters do I have? In the back of my mind, I want to keep it as minimum as possible. The key is to actually add as many filters as necessary to get a okay-looking equity curve. I think that's kind of the takeaway there. You don't have to have a beautiful-looking equity curve. You want to stop early and not actually torture the data. So that's what I have in my head. I'm going to add a filter or 2 and see what the equity curve looks like. And if it looks good with 2, what does it look like with 1? I might even remove 1 and then see what it looks like, because I want to do the minimum amount of work on that. Yeah.
Okay, so sorry, I just lost my train of thought there, but so then earlier on I cut you off when you said that you identify the filtering at the in-sample stage, and then if it looks good, then you move on. So what is the second part of that process then? Once you've defined or you've decided that this combination of filters looks good, what do you do from there?
Yeah, you know, and also it reminds me, when I mean it looks good, let's dig into a little bit more of an example right here before we go on to the step after that, because we might have missed that in a little bit.
Oh, okay.
Or didn't go into it in detail. Was, you know, a lot of these filters, when you put on, let's say, I don't know, a VIX, right? So you're going to test the VIX, and you're going to test the closing volatility based upon the VIX against a 20-day moving average. And you're going to use this as a filter. And perhaps you want VIX to be falling. So, well, you think it looks good, use a 20-day moving average. And what also you want to do, if that filter looks good, is also that has a look-back period, right? 20 days. So this is another area that I think a lot of people will trip themselves on, is, okay, let's optimize that, right? So let's optimize that 20-day moving average of the VIX. And I would encourage that. In fact, I do that for one reason and one reason only. I want to determine, is that 20-day moving average an outlier? Or if I do a 19-day or a 21-day, what does it look like? Ideally, I want the performance to be similar. So in other words, I don't want that 20-day moving average that I just randomly picked. I don't want that to be an outlier. So actually, I think one of the images I sent you.
Yes,
like
we have a slide
image
for that.
number 3.
Let me just put that up on the screen. This one here?
Yes. So let's pretend this is our optimization for our VIX, right? So we have on the x-axis there 2 through 30. So we have a look back of 2 to 30, and also on the y-axis we have our net profit. And so if you just let a machine pick the value, what's it going to pick? 4, right? It's going to pick that bar that's on the far left side. That's the highest one. That produced the best net profit. And we're assuming that we're filtering these by net profit. So what I want to do, if I was doing this and we picked 20, right? That was our default value. I want to look at this and say, is 20 a reasonable value? In other words, is it an outlier like 4? Well, it's not. If 4 is the outlier, 20 is okay. And we can see that values around 20 produce similar results. So this is what I do for all the parameters for each filter as well. So there's kind of a 2-step process in there. Hey, what does the filter look like generally with your default value? If it looks good, we can expand it and then see that it's in a what I call a stable range. So I would say values between 10 and 30 look fairly stable. 4 is clearly an outlier, and you would never want to pick 4 as that value. So I think that's an important aspect going forward as well.
Yeah, so that's a visual analysis, right? Have you tried to look at it algorithmically to see, where, or to judge the consistency of those values?
No, no, I keep it pretty old school, I guess.
Okay.
Just by hand like that, looking at it.
Yeah. So I guess that's kind of like the art of systematic or algorithmic trading, right? Is that I guess over time you get experience with these things, and you look at enough equity curves, you look at enough results like that, you kind of get a feel for it. Is that how you've come about coming up with this process?
Yeah, I believe so. You're training one of the most powerful neural nets, right, on the planet, which is in your head. And if you look at these enough time, you're going to be punished when you make mistakes by losing money and rewarded. And so there's your reinforcement and your training of your neural network. And so, yeah, I do look at it that way. And I don't have a quantified way of analyzing like that bar graph we just looked at.
Yeah.
I'm sure that people have ways of doing that.
Yeah. Okay, so once you've determined that the values are consistent over a range, and so would you select something in the middle of that range, or how would you actually go and figure out which specific value? Right. Okay.
Yeah, if you wanted to, what I would often do is take I would find whatever the stable range is, roughly, and then take from the left-hand side, let's say it's 10, and then the far right-hand side is 30, and between there looks pretty good. I would actually just add those up and divide by 2, and just kind of pick the middle value. And sometimes that's not the prettiest one, right? It might actually be the least producing one. That's fine, because we're not trying to build a perfect looking equity curve. That's the problem.
Yeah.
That's what we want to avoid.
Yeah. Okay. So once you've done this for each individual filter, you've picked a middle of the range value, which is consistent. Do you do any more testing there after that, or is that where it stops?
Well, that's basically the testing for the in-sample. So we're still working with the in-sample segment. And what we're doing is just finding components that seem to work favorable against our baseline or working with our baseline. And so after that, that's where I'll combine them at the end. So let's say we have our strategy here, and we have 3 different filters that we've determined look pretty good. What we're going to do is then combine them and then stay on the in-sample and see what they look like on the in-sample. And it's either going to look pretty good or pretty bad or just okay. And what you have to do is make a determination based upon net profit versus drawdown, what's your risk tolerance, and can you trade that equity curve? And what you'll make a choice on is, should I use all 3, or should I just pick 1, 2, or just 1, 2, and 3? So this is where I'll start playing with it a little bit. Let's say we have those 3. I might remove 1. And let's say it's that VIX filter. And what that will tell me is, what impact does that VIX filter have? Okay, then now let's put it back and let's remove that bull-bear regime filter. Let's see what kind of impact that has. And what I'm looking for is, I'm only going to keep a rule if it has significant impact on the baseline. So that's another aspect that's important. What does significant mean? That is subjective, right? Yeah. If I see something that only adds a few more trades, 10 more trades out of a system that trades 250 times, and it's only making me $2,000 or $3,000 more, that's not significant. Yeah. I wish I could give you a better answer on that, but I'm looking for something that creates a striking difference. If it doesn't create a striking difference, I remove it. And so, that goes along too, Andrew, when we're actually building out or testing those strategies against the baseline in the previous step, that I'm only going to keep filters, right, that have a striking impact on the performance against the baseline. And for some people, that will be different things. But again, for me, I really want to see a significant increase in profit and or drawdown. decrease in drawdown. And that what I would deem significant. Or sometimes what you see is just a reduction of trades. It becomes more efficient. I think that's important as well. And so I'm going to bring that same philosophy here at the end when I'm combining my favored rules together. And I'm always looking to remove stuff. And that's what I'm looking to do is I want the most simple, basic, strategy moving forward. Because in my opinion, I feel that that's probably going to work better on the data, which is unseen and unknown. It's going to have that flexibility to help adapt to that as much as possible.
Mm-hmm. It's interesting that you just said I'm always looking to remove stuff, because I think it's a common human trait that more is better, right? So I know a lot of traders are always looking, what can I add to make it better? But you're coming at it from a different angle, I guess, in that you're trying to take stuff out, which I like. Yeah. I think that's a good approach.
Yeah, that's a good distinction. When you're building a trading system, and we're doing completely opposite what most people do. You keep thinking more is better. Here we're going to remove, and I'm also always looking for a reason not to trade something. And that's another way to kind of keep it, and keep that in mind. So yeah, that's a good point.
Okay, great. So we've talked about you've done your independent testing on filters on in-sample data, and then you've combined them, and you're taking some out and looking to see the combination, the results of the combination, and the interplay between the filters. That's all on in-sample data, though, right? So is that enough then to go to out-of-sample testing? Is that how you do the process?
Yep. So like you said, now we're combining them. What we're doing is this is the first time that our filters, we're combining them, right, at this very last process. And then once we have something that we're happy with, then I move it to the out-of-sample. And that's the make or break moment, right? So the thing is, a lot of people, what they'll do is they'll move it to the out-of-sample, and they're like, that looks pretty good, but that spot right there doesn't look so good. If I go back and change something, and that's a big no-no. You don't want to take information from the out-of-sample segment to the in-sample segment. As soon as you do that, obviously what you have now is everything is in-sample. You can do that, but you have to put your system on a shelf now and collect new out-of-sample data over the coming months as the market rolls, as time rolls forward.
Yeah. So how many months would you leave it?
Well, that depends, right? If it's an intraday system, you might only have to wait 3-6 months. If it's a system that trades on higher time frames, you might be waiting several months, 18 months, 24 months, and so that's where it can become very difficult to do.
Yeah. We've got a question here from Google user. Do you use the same data for developing the idea to test the filters?
The same price data? Yeah, sure.
Okay, all right. And actually, there's another one here from Google user that's just popped up, so this is appropriate as well. Do you perform any permutation of the data during testing?
Not a permutation of the data, so I assume what that might be is altering the data, the price data, to as another validation technique. Now, I don't manually do that, but I know there's other tools out there, such as like Build Alpha, for example, which I've been experimenting with. They provide that ability to alter the historical data, price data, manipulate the price data, and introduce error into those price bars to see how your system adjusts or behaves on that. And I think that's really interesting and a very powerful technique. But when I'm doing this the old school way, what I call an old school way, which is just me and writing some easy language code, I don't do that.
Yeah, okay. So where do exits fit in all of this? Because I assume a lot of the filters you're talking about are entry filters. How do you manage the exits during this testing process?
Yeah, actually, I consider the exits. What I'll start doing is, a lot of them are real simple exits, and they'll be thrown right in with the filters. Is the different exits. So I might test an N-bar exit filter. I might test a crossing of a moving average, or another good one is just extremes of a indicator. Those will be tested along with there, and I probably should have made that clear too. When I mean filter, it's not just strictly filtering trades, it's also, I will be testing within there, also testing an exit. Now, a hard stop is tested at the very end, and I think I brought that up once, but just to make that clear, is often I'll hold off on the hard stop. My hard stop will not be tested until the very end. After I've combined everything together, I like the way it looks, let's do the hard stop test and then move it to the out of sample.
Yeah, but when you're testing entry filters or entry conditions, the exit that you use can have a very big impact on how effective the entry is, I guess. Do you worry about the interplay between entry and exit there, or what do you do to manage that?
Yeah, well, I guess I don't really focus on that a whole lot. So like for this example here, I had an example that we're going to mention, but when I have a key idea, oftentimes the entry, I just keep it. I'm not going to change that a lot, and then I'm just going to test various exits against it. So like I said, the N bar exit, or a moving average crossover, or price extreme, or a indicator extreme, that's what I'm going to focus on. And I probably will not touch that baseline at all. So I'm not going to play with that original entry. I'm going to keep that entry as solid as it is, and that's not moving.
Yeah, yep. Okay, we've got a question here about data from Jeff.
Sure.
Let me just put this one up on the screen. Excuse me. How reliable is broker data to do back testing? Is it reliable enough to decide to do live trading?
Absolutely. Yeah, it's absolutely good enough to do live trading. It's funny, I get this all the time. These questions came in on my website and from some of my students as well, about Jeff, this back test doesn't match yours, and this back test isn't exactly the way it should be. And well, it's never going to be that way, and that's really difficult. I think when you want to become a successful system trader, there are technical hurdles, and a lot of people can get over the technical hurdles, but when you have to get over some of these mindsets, and the mindset I think we're zeroing in here is we have to make decisions with imperfect information. And not everyone can do that. I liken it to a commander on a battlefield in the fog of war. And you have lives on the line. And they have to make decisions rather quickly with imperfect information, often wrong information. And we do something similar in that regard. This isn't the only two fields, and I'm not comparing us to generals, but just as an analogy. So that's really hard to get over. And I often find that people that come to systematic trading, they tend to be engineer types, right?
Yeah.
These are people that have gone through the school system. They're very detail-oriented, and they have been rewarded through life to be correct. Correct on their test, correct on their code, 100%, it works. And in trading, that's not really what rewards you. That's not necessarily going to reward you. In fact, it's going to continually frustrate you, and you're going to find yourself giving yourself excuses not to trade, and 2 or 4 or 8 years will go by, and you're still not making money because you're hung up on trying to be right and correct 100% of the time. The back test is far from imperfect, but it is good enough, particularly when you follow these types of steps. Not just mine, but there's other steps out there that traders come up with to help alleviate the probability of having a overfit strategy.
Yeah. We've got a question here from Vid. Let me just put this one up on the screen. Thanks for the question, Vid. How can you tell the difference between a normal drawdown and a strategy that is no longer working?
Well, okay, when you move a strategy from the in sample to the out of sample, and you're happy with that. Another test that I'll do after this, keep in mind, we're talking about a small segment of the entire development process, the independent portion. There's other things here. So one of those other things is after I have something that looks good on the out of sample, it satisfies what I'm looking for, then I'll do a Monte Carlo analysis on the drawdown. Nothing fancy, nothing very special, and I'm going to find out it's about a 25% drawdown. And what I will do then is just start monitoring that strategy in the live market. And if it starts behaving in ways is, 25, when it starts getting down to a drawdown of 25%, then I'll start worrying about pulling it. The other thing I'd look for is it just not performing? It could just flatline, right? It's not making new equity highs and it's not making new equity lows, or excuse me, new drawdowns. It's just kind of floundering.
Yeah.
And what will happen is when you're rotating systems, right, you have your portfolio, that will get flagged as a weak strategy and you'll get replaced by a different one. So those are the two kind of things that generally happen.
Yeah, yeah. So just then, when you said that you like to monitor it in the live market, do you, if you've decided to trade a strategy or it's acceptable, do you start trading it, or do you, when you say monitor, are you like doing like demo trading, or just seeing how it goes before you put money on the line?
Yeah, yeah. A lot of times I'll get through the development process, and I'll just pull the trigger.
Right.
I think I was more cautious in the past, and probably rightly so. But I feel now I have the confidence that I think the vast bulk of the time, the new systems that I put on this year, I just put them on and let them go.
Yeah, yeah, okay. We've got a question here from Sco. G'day, Sco. Thanks for the question. If you do this process regularly for a very long time, I imagine you might have many promising strategies. How do you choose to turn some off and pick new ones to actively trade?
Yeah, that's going to depend on several things. It's going to depend on your account size, right? It's going to depend on which markets are you trading now. So I might have an overabundance of index systems, and the last thing I need is a new index strategy. So maybe I need something more like for trading corn. And then if it's fairly well balanced, and okay, I got this other corn strategy or soy meal strategy, I'll start comparing its performance in terms of like net profit versus drawdown to what's trading live. And if it's an improvement, somewhat of a significant improvement, because I already got a strategy that's working, then I'll pull the plug on a strategy that might be working to substitute one that's doing perhaps a little bit better. Mm-hmm. That's what I would do.
Yeah, yeah. Now, I know we have a slide here that kind of explains your entire process. So maybe now it might be a good, because I recognize we're only talking about specific parts here. Maybe it might be good now to spend a couple of minutes on the entire process so people can get a context for it. So let me just put it up on the screen. Here we go. Yeah,
so this is what I call my 12 steps to a profitable system. It's another creative name for this. And basically, these 12 steps are something that I've been doing for close to 10 years now. They get refined. Yeah, you could shuffle around the first couple, do number 2 first. But generally, this is what I have. It's a 12-step process. And we go through this every time I build a trading system. And you can see here on step number, where are we? Independence testing, step number 7. That there is really what we're talking about tonight. That all that conversation really encompasses most of that block 07 there. And there is other steps here that I go through. Now, this is a lot of information. And I think this is another good tip for people. I'm pretty methodical when I record information. And, if you remember back to your high school days, remember chemistry class? And you had a lab write-up? And the lab write-up was like this instruction book, right? Where you would write down your experiment. Oh, these are the beakers I have. This is the material I have. I pour this acid here, or I put it under a Bunsen burner. You record your results and observations. That's what I do. It's called my SDN, my System Development Notes, and it's really a advanced checklist, probably about 20 pages long, that walks me through this process, 12-step process, to make sure that I do not forget a step and that I write down my observations. And I found this invaluable, particularly when starting out. I think having a repeatable set of steps is very important, and having a checklist or this lab write-up is very important. Not only does it make you not forget, right? You're gonna see what steps happen in what order, but you could go back to them and review them. So I encompass these 12 steps into my lab write-up every time I create a system. And I think it's invaluable. So if you're not writing stuff down and recording your steps and your process, I think you should do that. I think you'll learn a lot doing that, and also prevent a lot of errors.
Yeah. So I imagine doing this process over years, and you've probably tested hundreds and maybe thousands of ideas. You must have a lot of research notes. How do you manage that? And do you ever go back? Do you ever go back and have a look, or what do you do with all that paperwork?
Yeah, a lot of it in the old days was paperwork, and I should have brought a picture of that too. I used to send people, this is my notebook of ideas, and I would actually print out my 20-page lab write-up for building my corn system and put it into binders. Well, now it's in Google Docs, right? And recently I've moved over to taking a hard look at an online service called Notion. And Notion is like an online database. And the reason I'm doing that is because it provides a lot of flexibility for sharing. So I think you should have some type of management system, either Evernote, OneNote, Notion. What's the other one? There's another one that's really popular, Obsidian. Those type of content management type or information management systems can be helpful. So I hope that answered that.
Yeah. So what about, there's probably ideas that you tested 5 or 10 years ago that weren't too good then, and maybe they work all right now. So do you ever go back and look at that and review? Yeah, right.
Yep, absolutely. You go back to them, maybe it was 2 or 3 years later, and you're like, you see it with different eyes, right? So every year you're growing as a person, as a trader, and so you have a fresh set of eyes. And going back and reviewing this, you may take a piece out of a system that you tested 2 or 3 years ago or longer and say, ooh, I didn't test this, or that component looks really good. Maybe I should explore that more. And so, it becomes what it becomes is another resource for pulling ideas from and seeing ways to improve. Yeah.
Yep. Okay. Here's a question from BK. G'day, BK. BK's a regular. Here we go. Do you use these methodologies for single symbols?
Single symbols? This is all for building a single strategy for a single market. That's how I do it right now. And then they would be combined afterwards into a portfolio. So I hope I answered that correctly.
Yeah, I guess. Yeah, I guess the extension of that question though is you come up with an idea and you test it on ES, or the E-mini S&P 500. Would you then go and test it on NASDAQ and Russell, similar kinds of symbols, or is it just this idea is just for that symbol and nothing else?
If you're building, exactly. If you're building something for the stock index markets, ES, for example, I will test it on YM, maybe NASDAQ as well. And just to see how it does. It should hold up reasonably well. I don't expect it to look perfect. I don't expect it to look anything really like the other one, the one that I'm building it for. But it should be okay. So, yes, I do that. But they don't have to. It doesn't have to be perfect.
Right. Yeah. Okay. All right. We're going to start wrapping up here in a sec. But here's a question from Google user. There's a good one. How many tests do you conduct on a strategy at a maximum before you give up? There is a saying that this is going back to the torture the data you said earlier on. There's a saying that when you torture the data long enough, it will confess anything you want.
Yeah, I heard someone say that. Yeah, that's great too. That's how you got to look at it. As morbid as this, if you're torturing it, it's going to start telling you things you want to hear, right?
Yeah.
So that's very good. So I suppose when you're going back to the independent testing phase and you're plugging in filters, there's times when things just they're not working right off the bat. Within 15, 20 minutes, you could probably tell this just isn't going where you want it. An hour in, if you find yourself not moving forward, it always seems to me that part of that torturing of data is you lose your momentum and you're stuck. If you find yourself stuck, stop. Maybe put it on the shelf and come back to it. Move on to the next idea. Because often a good idea will tend to flow really well. Often just like a trade, right? A good trade will tend to work in your favor right away. this will tend to work in your favor moving forward as well. And if you get stuck, and I can't say what time, is it really an hour or two? I can whip through these pretty quick now because I wrote, custom code to help me along with this. But
Yeah.
You just have to be aware of, am I torturing this data? And if that's starting to pop up in your head, you might want to put it aside and move on to a different idea.
Yeah, I guess that's the benefit of having a long list of ideas to test. Right, is you're not so desperate for one to work out. I've seen traders before; they almost get attached to an idea, emotionally attached, really and they're like, "I've got to make this thing work." And that's based on what you're saying there. That's the wrong way to do it. Just give it some time. If not, move on to the next one. So. Right,
exactly. I the same thing. I've had so many people contacting me where they show me this strategy that they've been working on for 6 months, right?
Wow.
And it divides the market in the bull bear phase. It does this. It takes into account to that. I'm like, oh my God, I've been there. I've done that too. To create the ultimate trading system, and it's not worth it. It's quicker. The idea here is in the business world, when you're creating products, you want to create the minimum viable product first, and that's the bare bones essentials, right? That's how I look at it. This is putting out to the market the minimum viable system that will work. It doesn't have to be pretty. You know what? You can always come back to it and change it. If you see in the real market that something might need to be tweaked, you could do that. But the idea is to get ideas out on the real market as soon as possible for multiple reasons, for just your sanity and for your training, because if you don't put money on the line, you're never going to grow as a trader. You have to do that.
Yeah, right. So just one final question before we wrap up then. You just mentioned that if you see that something's happening in the market with your strategy, you can tweak it. What do you exactly mean there? Are you talking about re-optimization, or how do you manage that process?
Sure. Sometimes what will happen, a lot of times I don't really do much re-optimization. That rarely happens, but that could happen. So that's one. Another thing is, after watching it for several years, maybe the market changes a little bit. In fact, there's a system in my head right now that I've been kind of eyeballing that, I'm getting out at 3:15 Central Time. And it happens to be an ES system, or an NQ system, so the stock index. And it exits at 3:15. But I've kind of noticed that I think over the past year that getting out 15 minutes earlier might be better, right? So that type of thing. So what I'll do is I'm going to look at that eventually. It's on the docket here. And I'm going to take a look at that and see if that actually would have improved my performance over the last couple of years. And if it did, I would be comfortable with that small tweak moving forward. Put it in and move forward. I am not going to be doing that constantly. Now, what does that mean, right? Well, I've been trading this thing live for well over a year. It's got a number, over 30 trades under it. So I don't feel like I'm interfering with a system. I don't turn systems off. I let them, as painful as it is, I let them go through their drawdown. And I would be comfortable with doing that. So those are a couple of examples where, I would change something on the live market.
Yeah. All right. Well, thanks a lot for that, Jeff. It's been really great chatting with you today. And so how can people, if they want to get in touch with you or learn more from you, where can they go for that?
Yeah. Well, the best place is to go to my website, EasyLanguageMastery.com. There you'll find my contact information, and you'll find places to sign up for, my weekly, it's actually a bi-weekly newsletter, and get more information about the courses that I teach, as well as a ton of information. I started creating this type of website. It used to be called something else in the past. When I was learning this stuff, I would just put it out on a blog. Hey, look at this, and that's what this blog grew from. Is just me sharing information, key ideas, filters, and trading ideas and concepts that I think were helpful. So if you go to EasyLanguageMastery.com, you'll find a bunch of information and a lot of code you can download, as well as TradeStation workspaces, so you can play around with it on your platform.
Yeah, I know your previous blog, System Trader Success, right? Had a lot of great research and had a lot of impact on the trading community. So I know there are thousands of traders out there that appreciate the work that you've done on your old blog and now on your new blog as well. So thanks for sharing that. And the code too is always very helpful, especially for beginner traders who are just kind of finding their feet. So thank you very much for sharing everything on your website. I know I've been there a number of times and got ideas as well. So that's
good. I'm glad to hear it. I love sharing the information and I love getting the positive feedback like that. I always tell people it always puts a smile on my face. I feel good about that. So I'm very happy about that.
Yeah. Okay. So just wrapping up now, we just got some feedback in the chat, which I'd like to share a couple of things here. So good old boy. Thank you, Jeff. I've been following you for years. You are always helpful and kind and patient. So
thank you. Appreciate it.
Thank you. We've got a few more here. Stone. Thanks, guys. Amazing talk. Keith said, thanks, Jeff. Enjoyed your perspective. And they're going too fast for me to grab now. One more from SCO. And Google uses a regular, so let's go. Nice podcast. I enjoyed it. Many thanks, Andrew and Jeff. So, thanks again for your time today, Jeff. Really do appreciate it. And it's so great to speak to you after all these years of trying to get you on the show. So, thank you very much.
I appreciate it. Yeah, you got the hermit out of his shell. I tend to be kind of a recluse and don't do a lot of public appearances. But me and you, we go back a ways, and I definitely wanted to help you out in your podcast. I listen to, of course, and always enjoy it. So it was really my pleasure to be here.
Yeah. All right. Well, thanks again for your time today, Jeff. And thanks for the audience for showing up today and all the great questions. Apologies we didn't get to all of them, but you can always contact Jeff at his website if you need some more information. So thanks, everyone. And take care, Jeff. And I'll catch you again sometime soon. Cheers.
All right. Take care, everyone.
Thank you. Bye-bye.